Investors, welcome a very special guest. We have Brad, also known as the Income Architect on YouTube, where he talks about everything income investing, cover call ETFs, and everything about passive income investing. Brad has a little over $1 million invested in income producing ETFs with 12 months of living expenses in cash, as well as a growth portfolio as well. Brad is retired and is not collecting any Social Security because he's living off his portfolio that pays him around $172,000 per year in dividends, or just over $14,000 per month in dividends. Brad's top 3 income ETFs right now are QQQI by Neos, KGLD by Curve, as well as TDAC by Tap Alpha. Brad's top 3 growth funds are TQQQ, which will soon be just QQQ. NUGT is his next top holding, which will soon be BAR. And then he has IBIT, a Bitcoin ETF. We're going to get an inside scoop on Brad's successful investing journey, some tips for success, and so much more about his investing portfolio and everything in between. So first question for you, Brad, is how are you feeling about being on the channel? This content is sponsored by Neos Investments, which is for educational and informational purposes only and not financial advice.
Just love being here. It's exciting to meet other people in the YouTube space. I think we met in person in New York, and it's always great just to be on somebody else's channel.
First question for you, Brad, is can you introduce yourself as well as provide an overview on your investing journey from the beginning to now in retirement?
My name's Brad, and I live in an RV down by the river. Actually, I don't. I live in an RV resort. I started my journey right out of high school, went to a corporate job, moved up through the ranks. I did a little bit of military time, but went right back to the corporate job. Back in the 80s, it was all about investing in your 401k. Put 10% in and you'll be okay. Did a lot of growth funds, moved up, and then right around 2000, they had self-directed 401ks. And I moved portions of that over, and I decided to buy something called BITO because that was something that I was able to do in my actual 401k. And that ended up being where I am today because I wrote it down and I wrote it all the way back up. And that's where my journey ends because I was able to do something with not just holding those mutual funds that they had in my 401k.
Now, what first got you interested in income investing? Because you said that you started out as a growth investor buying some growth funds, but then you transitioned to income ETFs.
So I read a book by Stephen Bavaria, the Income Factory book. It gives a general guidelines. I don't agree with everything that's in his book, but I do agree with part of his philosophy. And that is everybody's journey for income investing. We all have our own journeys. We all have our own perspectives. And I liked what he said and said, I can do something like this and create a portfolio that I can live on 8% and reinvest the rest.
What were some of your biggest money lessons or investing lessons that you learned before you hit retirement?
I wish I would have bought more Microsoft back in the 80s and 90s when I realized that Microsoft had a grab on the market because everybody was using that software at the corporate job. Did buy a little bit of Microsoft, but it was later in life. But recognizing some of those trends earlier, like what tools around the office do you see you using every single day, growing more and more into your life, that would have been a better investment than a lot of things. And that's just from my recognition of my investing journey. Instead, I had SPY, or actually didn't even have SPY. I had a mutual fund.
Now, walk me through some of your favorite ETFs in your portfolio, or maybe even how you structure your portfolio. So do you have a brokerage, the 401k? Do you have a Roth IRA? And I know you have these different baskets of portfolios in Fidelity, I believe. So, you have some Neo, some Curve, some Tap Alpha. So just give us a brief overview of that portfolio.
I use baskets at Fidelity. And it allows me, I like the 60-40 rule. I try to do about 60% in equities, but 40% I do not like bonds. I don't think bonds is a really good place for me as an investor. I do some preferred stocks. I do some business development companies. This is also where I put my crypto, BTCI, my gold and silver funds. And I do have a credit company that I actually learned about from Stephen Bavaria. And I use Stark or Stretch, I do believe they called it STRC from MicroStrategy. Pays about 10%. I hold a little bit of cash in that. And that is where I end up holding some cash, but I also have a cash portfolio. That's just me. 60% equities. I have themes. I prefer AI. I prefer the Qs. I prefer semiconductors. I don't think that those are going away in the next 3 to 5 years. I think those are where majority of the growth is coming from. So that's where I'm more invested than the Qs and AI and semiconductors, such as SOXY and Chippy and GPTY, the Qs, TDAC, KQQQ, QDevo. Those are all great funds, and I just don't try to pick one. You can pick one. You can just have everything in QQQI, but what happens when one of the other funds outperforms? So I kind of spread it among all the funds, not just one fund provider.
Now, you told me that you are a hybrid investor. So why are you a hybrid investor? Why not just go all in on dividend investing or cover call investing, or just all in on growth?
My whole philosophy, and this is from a different book, is you should only have what you need in income investing. I actually say about between 130 to 200%. After that, cover calls have been known to actually cap you on the market side going up. Have what you need for income, so your income needs is taken care of, and then everything else should be in growth. And that's just my personal journey.
What do you think is better for short-term investors versus long-term investors? Is it going to be income ETF investing, or is it more growth investing?
For short-term investors, that's more of a day trading. I would not use income funds. I would actually use, if you're going to be a short-term trader, just like my whole TQQQ trade, that was a short-term trade. That's not normally what I hold, but I did that because President Trump said that we should buy the market. I took that as risk on opportunity. And as of actually today, at this filming, I've actually have changed that all over to QQQ. I chose QQQ because I still write my own options every now and then. QQQM is probably a better hold because of the ratio being lower. But since I write my own options, QQQ is a better option for me. I just don't do it all the time because I don't want to do that for my retirement. I just do it to pick up 1 or 2 extra % a year and call it good.
Now, what about for long-term investors? Because you have, of course, $1 million plus in your portfolio, and some investors might want to know how they should be thinking about investing long-term, maybe for income or maybe for growth.
This gets into probably one of my biggest mistakes in investing. 401ks, make sure you put your money in, get the match. If you're going to try to retire early, like I did, you need a brokerage account also. And that's where I made my mistake when I was younger. I was maxing out my 401k. What could go wrong? I get 59 and a half. I'll have all that money saved up in there growing pretty much freely. Now I'm going, oh my, I made that mistake. I should have had more of a bridge account to get me through. But I look at it in the aspect of at this pace, I'm worried more about what I want to have to do with RMDs when I turn of age to have to take RMDs, because I don't think I can spend down my money fast enough.
What were some other huge mistakes you made along your journey besides the 401k and not having a brokerage account?
Not doing enough of my own due diligence. What am I talking about when I say that? Well, I've read the book, The Income Factory, and I look at some of those funds today that are listed in there, and they're down 41% year to date. And I go, I am so glad that I didn't get into all these funds because that would have been devastating for me in retirement. I did get into it, but got out of it way back in January when I noticed things weren't going quite the way that I thought they should be going. Doing that due diligence, knowing what you're trying to get is so important. And that's what I try to do on my YouTube channel. I literally go through the options trades, show people how they've worked month over month. I think one of my most favorite videos that people watch is I actually do the NEOS calls, showing you exactly where those calls are month over month. And I can bring them up since the beginning of the year and show you since January to now where they placed the calls and where they finished out of the money, in the money, and how that strategy's actually been working for them.
I've seen you do interviews with NEOS quite a bit, as well as Curve and other ETF issuers. Now, walk me through, you said, NEOS, why you like NEOS's products and why they are such a good issuer, because I know that a lot of ETF investors who want income gravitate towards their funds.
I do believe it's due to their consistency and their straightforwardness. I mean, they went back and did a 20-year back test on SPY. It's actually publicly available on a actually index if you look it up. So you can actually see how this has worked over the last 20 years. So I really like how focused they are on producing products that are thoroughly back tested. Other people, I actually have to question, did they just come up with a strategy and not back test it? And sometimes you look at that and you can actually think about how these things are actually been operating now for over a year. And it's actually proven out that maybe they didn't back test them as well as they should have.
You told me that you believe investors can generate a yield that can allow them to live on 8% of the cost of their portfolio and reinvest the rest to outpace inflation. Why do you think that living on 8% is the new norm with income ETF investing, and is the 4% rule old news?
Really do believe the 4% rule is old news. Now, I still hold 12 months cash just in case, but so far in my retirement, we've had a big downturn. I never had a fear of running out of cash. That portfolio can really do well. And just to give you a quick number, if it's paying 12% as a distribution and you're taking 8%, you can handle a 33% downturn in the market and still get your 8%. So my portfolio on average is right around 14 to 18%, depending on the month. That gives me a huge leeway for a downturn and still be able to collect my 8%.
How did you know that you were ready to retire? Was it a certain number in your portfolio as a value amount? Was it a certain amount of dividends you were earning per month or per year? Or was it something else that signaled you that you were ready to retire?
I got tired of working. That's actually probably the most honest answer. I always knew that I had enough money, but one day I decided this was enough. I was doing a corporate job. I was traveling all the time. I was out your way in LA and said, I can do something better with my time than handle all these issues day in and day out at the corporate job and live life on my terms and not somebody else's terms.
In terms of retirement and being able to be ready to retire, a lot of people gravitate towards income ETFs to have that money to retire. Would you say that you were already in the income investing mode, or were you still in growth before you were ready to retire?
Great question. I already had my SPY. I was already building out my QQQI. I wasn't quite ready to retire. I probably wanted to work another year and a half, but decided I was already on my journey for income investing. And I already had a core base, but I still had a lot left in growth. I tell people when they start talking to me, right around that 5-year out to your journey or to that magic place that you think that you want to be, That's when you really start needing to be focused on, is it enough? Are you going to be making enough? And that's when it really comes down to what your goals are. Because once you hit retirement and you don't have any income coming in, it really changes the life views of things.
You said that you have a 14 to 18% dividend yield. In your opinion, what is an appropriate and a sustainable dividend yield for investors? Because we're seeing, those 50, 60, 100% yields, even at one point, but you're at 14 to 18%. So what is an appropriate yield for income investors?
I'm just going to say it's actually all up to the actual individual and their risk tolerance. But obviously, SPY pays 12%. You can even go with the QQQH that pays 9%. These are all great funds. They all have different risk tolerances. So it really comes down to what you actually want to try to accomplish. I'm more of the maverick. I do believe somewhere between 14 and 18% is probably doable. But I also have diversification with the business development companies paying me about 12. Some of them only pay 10. So I do have those in the mix.
Since you have that dividend yield of 14 to 18%, why not go higher or even lower? Have you ever thought about, doubling that yield, tripling that yield, or even just cutting back on the yield?
All the time. I struggle with that every single day. One, I do believe we should all have a little bit of Bitcoin in our portfolio, even as a retiree. And it's all up to the individual, 5%, 10%. I've heard 20%. I can't tell you how much you should have, but even Neos or Amplified with their Biddy, they're paying 24 to 30%. That really kind of juices the distributions that you're getting. I mean, we're making 12% on gold, 17% on silver, and I think the first silver distribution was like 22%. So you sit back and go, if I'm going to hold silver, if I'm going to hold gold, if I'm going to hold Bitcoin, some of these things really get up in that 12 to low 20% ranges. And you just sit back going, how much of each one do I have in my portfolio? And that's, again, an individual discussion. But I do believe I put up a video one time and said 60% QQQI and 40% BTCI. That would be paying me $240,000 a year. Just a little more out on that risk curve for me.
Were taxes ever a big burden for you, earning right now $14,000 per month in dividends? Because a lot of investors are super curious about somebody in retirement, if taxes are going to be a huge burden on them from all these dividends and distributions, return of capital, and so on and so forth.
Another great question. So because of how I was raised, being in a 401k and an IRA, everything that I actually have, and it's probably one of my bigger mistakes, is everything's in tax deferred accounts. Because I'm not 59 and a half, I am paying the penalty coming out. But I also live in a state that doesn't tax me on withdrawals. So really, that 10% penalty is the same as paying California state tax on the same investment. So that's one thing that you should actually start thinking about. Where are you going to live for taxes? Because not every state is the same way. California has high taxes where someplace like South Dakota or Florida has a different tax bracket, even Texas. But they, don't get me wrong, they get their money one way or another.
Why do you like cover call ETFs versus traditional dividend ETFs like SCHD? I've seen so many people compare, SPY-I, Triple QI, any cover call ETF versus SCHD. So why do you think, or why do you like cover call funds versus an SCHD, for example?
Well, one, SCHD has underperformed the last couple years, and that's really due to how it's structured and what funds it actually, or stocks that it actually holds, right? They're more defensive. Can work for or against you. I prefer technology. Right now, the last 10 years, what's been driving the market has been the technology sectors. I'm fine with something like QDevo that pays a little bit less and gives me a little more price appreciation because it still gets me more than my 8%. But I'm not fine with something like a SCHD that just seems not to perform as well as even holding SPY when you look at total returns.
So many influencers, even myself and other YouTubers, make videos a couple years ago about JEPI and JEPQ, which were some of the most popular cover call funds, even QYLD at one point. But now we have so many cover call funds, I would say, newer enhanced versions of JEPI and JEPQ. For example, we got SPY-I and Triple QI, which often get compared to be better versions of JEPI and JEPQ. Now, do you think that JEPI and JEPQ are dead compared to all the new cover call funds in the market?
I think that even SPY-I and QQQI may have problems. I'm going to call JEPI and JEPQ revision 1. I'm going to call QQQI and SPY-I revision 2. And I'm starting to see revision 3 ETFs come out that might be even better for the investors because they are providing different strategies than just a cover call to try to get away from the stigma of cover calls.
What are your thoughts on NAV erosion? Because a lot of income investors hate that term, hate seeing NAV erosion. And do you avoid those high NAV erosion ETFs?
That's even a better question. So at times I have been caught yield chasing and getting into funds that do have NAV erosion. I personally think, and this came up in the interview the other day with Curve, as a retiree, NAV erosion is just bad. Now, if you're only a total returns person, NAV erosion doesn't matter. If you're reinvesting every single distribution back into the fund, it doesn't matter. The total return is the total return. But the total return is not the total return if you're not reinvesting back into that fund. And since I'm drawing on mine, I want a fund that has capital appreciation. It doesn't have to be huge appreciation. I mean, I'll take 3% appreciation and a 10% yield every day of the week. What I don't want is a 15%, 20% yield and a negative NAV. It doesn't get me where I want to be in life.
What are your thoughts on investors investing in leveraged cover call ETFs? I know Neos will soon have their boosted series. We have Roundhill, which has some leverage, as well as new issuers going to be coming out with, I guess, leverage version of their cover call products. So do you like those ideas of having a little bit of leverage to, I guess, if the underlyings were to go up, that the charts would be green and there would be less NAV erosion? But of course, if the market were to fall, then these funds would have heavy NAV erosion because they are leveraged.
Craig, another one. So I do own NVII from RecShares, which uses leverage. Really like that fund. I've never, ever had to reinvest a penny in it, but I'm also ready to reinvest back into it. And that's because I believe in NVIDIA, because it's a growth and income. And I kind of like that. I'll go ahead and say I'm personally interested in the boosted funds coming from Neos. I think that was another one that I'll buy. I'll buy the QQQI boosted fund just as a smaller portion of my core, called a satellite holding. I still think my core holding will be QQQI, QDevo, KQQQ, and even GPIQ. I hold all those because they all have different strategies, but doing some of the satellite ones actually can help boost that actual income. Just got to be careful. I also think that the Roundhill ones is more of a directional play. As long as the market's going up, or those particular stocks are going up, they're just fine. When the market goes down, well, you might not like what happens.
Give me your thoughts on margin, because we see other investors taking out margin to boost their returns, increase their risk, but also juice up their dividend income to pay off the margin. So what are your thoughts on margin? Would you ever do it? Have you ever done it? And is that something that you would ever consider?
So no, I've never done it. Yes, I would consider it. And yes, you can get better returns using margin. My only comment is it's just like me going into TQQQ. Somebody told me to go risk on. President of the United States. I went risk on. I think today you might want to have that margin paid down as far as you can, because we might be seeing a little more turbulence in the marketplace. But that's all about your point of view and where you are in your journey in retirement. Because we are a little more risk adverse, it's a different journey than if I was in my 20s. Because if I was in my 20s, oh yes, I'd be using leverage. I would be using it reasonably, but I would be using it. And that's just because I'm at a different point in my life than maybe somebody in their 20s and 30s.
Do you prefer monthly dividend ETFs or weekly dividend ETFs, and why?
Okay. I'm sorry for laughing at you on this. So that is weekly, until I started using Snowball, was driving me crazy. How much was coming in on what day, and was I going to reinvest? And yes, it almost got too much. In retirement, weekly isn't too bad. Monthly I can live with. And I have some business development companies that pay me quarterly. So I can actually do my own budgeting, but I really like the monthly side. Weekly gets a little much. I mean, I think I got paid every day this week.
When you receive dividends and dividend paychecks, how do you drip? Because so many investors have a different way of dripping when they receive income paychecks.
It depends on the marketplace. Depends if I'm going to take a withdrawal from my account. This month, I'm not taking a withdrawal. So I receive money. I look for a red day, and I look for something that is generally either below my cost basis or a position that I still want to build out. And it really just becomes, is it a good red day like it is actually today? I might buy a couple shares.
I've seen and heard so many people who are late to the game in investing. They might be in their 50s and 60s, and they're looking at cover call income investing. Well, what are some tips that you might have for them if they're super late to the game? Because some of those investors might be chasing the highest yield possible and just want some, words of wisdom from someone like yourself who is in retirement and has done this for quite a while now.
Watch the NAV erosion. Younger investors reinvesting all the way back in, not a problem. You really want to look at a chart that has a little bit of price appreciation. It doesn't have to be much. It just needs to have some price appreciation, and just be careful and do your due diligence. I mean, there's a lot of great funds out there by a lot of great people actually issuing these funds. You just got to pick out which ones you like and which ones you don't like. And it all comes down to your actual personality. Me personally, like I said, like a little bit of price appreciation. QQQI is like 7% above my cost basis right now. And I can handle a bigger dip. So having that, especially once you retire, gets a little more focus. And I really focus on not reinvesting when it's above my cost basis, because it's going to increase my cost basis. And like I just said, QQQI is 7.5% above my cost basis right now. So the market can go back 10% before I would even think about reinvesting in it.
What do you look for before you pull the trigger on any cover call or high income ETF?
When I first started, I didn't do enough due diligence. Now, I track the calls. I literally put them on a spreadsheet. I look at the calls. I watch the fund. Because I'm actually on YouTube, I get to talk to a lot of the fund managers, and I got to start picking apart what I like about a fund and not like about a fund. And then I watch it for a long time before I really start creating a position. When I first saw Soxy come out from YieldMax, I was like, oh, it's a YieldMax fund. I don't know. Well, that was a bad decision. That would have been a great fund to be actually in my portfolio when it first came out. When I saw GPTY, I don't know. But now that I look at it, that one's turned out to be a really good one. So you sit back and not all the funds are for you or for me or for somebody else, but think about what you're trying to accomplish at the end of the day.
Does dividend frequency matter? We've seen cover call products go from monthly. Now everybody seems like going to weekly. And now we have 2 dividends per week. And soon I think we might go daily. So do you care about how often these ETFs pay you dividends?
No, I don't. And that's just me. It almost becomes almost overwhelming about how frequently these things come in. Like I said, I get paid every day this week. I got paid. How do I keep track of that? I mean, how do I know how much is coming in? I use Snowball, like I previously said, but if you're not using something like that, it almost gets to be too much and too overwhelming, especially if you have a whole lot of funds.
Do you think that the average investor who wants to, I guess, retire one day from income investing could do it? Because it seems like, a lot of these investors have so many ETFs in their portfolio, it might be hard to manage. Some of them might have NAV erosion. Some of them might be going up and down. They might have like 30, 40 different ETFs. There's going to be so many choices of which ones to go for. And you're going to have so many influencers talking about the pros and cons. And it's just like more complicated versus back in the day, or even for a couple years ago, it was just buy VOO, buy SCHD, buy the Qs, buy a growth fund, and then call it a day. But now it seems like income investing is becoming more of a lifestyle than just setting it and forgetting it.
Figure out what you like. I like the Qs, and I'll just give you the list. QQQI, TDAC, QDEVO, KQQQ, GPIQ. And because I use Fidelity and I use Fidelity baskets, when I look at my Fidelity screen, those are all in one basket that says equity. So I don't have to look at all the different ETFs. I also have one that's called singles for all the singles. So I do have some of the round hills. I still have some of the actual rec shares, and I have that in there. And when I look at it, I can see if my single portfolio is up and my equity portfolio is up. And then I have all my business development companies in one basket. So at the end of the day, I'm only looking at 7 different baskets instead of 80 stocks or 80 different ETFs.
How did you learn about cover call investing and being so good at it? Looking at the options daily it's super hard. Just people grasping their head about cover calls and options and derivatives is really confusing. So how did you learn about income investing, cover calls? Was it reading? Was it time in the market? Was it interviewing ETF issuers? How did you really learn about this whole process of cover calls and income investing?
It was called the pandemic. When the pandemic hit, I watched a gentleman, and I'll give him a shout out, Brad Finn on YouTube. I had nothing else to do. I was a corporate traveler. I wasn't allowed to corporate travel. I watched his channel. I learned how to options trade. And then when I started reading Stephen Bavaria's book and I started looking at covered calls, I knew what all that meant because I learned that during the pandemic, and it was just education. And I really recommend anybody reading and educating themselves. I even have a member of my circle community that wanted to take a course on options trading, and it said you can never go wrong in investing in yourself.
You've interviewed so many ETF issuers. Neos, Curve, Yield Max, Tap Alpha, and so on and so forth. So many ETF issuers. What are your biggest takeaways from these interviews? And do you have like a radar on what makes a good ETF issuer versus a bad ETF issuer? Because we're seeing all these ETF issuers come on channels now, and investors might want to know which are the good ones and the bad ones. And what do you think about these interviews?
I do a lot of interviews. I like to talk to all the fund managers and get their perspective. I mean, I look at all kinds of things, and that's a really difficult decision because I look at somebody like Yield Max. He does a really good job at explaining things to us. He does a really good job at telling us how it's functioning. And not all their funds are bad. I mean, you put Soxy on a chart and just go, that looks pretty good to me, right? But you took other things on the chart and you're like, well, that doesn't quite fit into what I want to try to accomplish. So you sit back and go, look at how these people are coming to market. Have they back tested their strategies? That is something that I ask almost on every interview. I might not ask it on screen, but I can tell you that Neos back test, Curve back test, Tap Alpha has back tested. That really tells me that back testing should be something that each one of these ETF issuers should be doing. And then some of them I know have literally said they haven't back tested. They let the option premiums dictate where they're going to sell their cover calls. And I sit back and go, when somebody says that to me, it starts to be a red flag. I want something that's been back tested at least a couple years just to see how it actually functions.
Which do you like more? Single stock cover call ETFs or index-based cover call ETFs?
When I first started out, I was all about indexes. I think you can juice your yield by getting a little bit of singles. Don't go all in. I mean, I own NVII, but it's a very small holding compared to my QQQI. Again, I think it's more of a satellite ETF. I think that something like the new K yield from Curve, when Howard was on the channel, explained it as a satellite ETF away from a core ETF. Like KQQQ is more of a core, where this is more of a satellite ETF.
In terms of a recession, stock market crash and the market pulling back really hard as an income-focused investor mostly, but also, hybrid with growth as well. Are you nervous about a stock market pullback because you might see less income, your portfolio value drop, and you are also in retirement? So is that of concern to you?
Yes, it is. And if you followed me long enough, I did believe I did a video and said that I sold all my growth when we crossed the 200-day simple moving average. I got a lot of negative feedback on that. Guess what? It was probably, if I would have shorted the market at that time, I would have been the GOAT of all investors, but I didn't. Looking back, going as a growth investor, I have been known to sell all my stocks or ETFs, and I can do that because they're in a tax-deferred account, and I don't have to worry about the taxes when I sell them, is follow the 200-day simple moving average. I'm actually using a signal from a third party now to tell me when I may be moving to YQQQ to actually have a little bit of a short perspective. And remember, these ETFs doing this for us weren't even around a few years ago. So this is all new to everybody. So using the tools that are out there might be prudent for an investor.
And now how would you react for the income side of your portfolio? Because you said you would sell stuff on the growth side, but what about the income side?
So I would sell a little bit of the actual income side and put it in YQQQ from Yield Max. And if you go look at a total returns chart, and if you would have done that when it crossed the 200-day simple moving average, you would have been better off as an income investor, especially now that YQQQ is paying weekly.
What does financial freedom mean to you now that you are retired?
Wow, it means everything. I get to spend days at the beach. Yes, I make YouTube videos, but this summer I spent almost every day at the beach having lunch with my wife, enjoying the waves. And you just don't get that time back.
How has your mindset shift throughout your investing journey about money and investing now that you are retired?
Now that I'm retired, it is conservative. I got to make sure that my money lasts me for the rest of my life. I mean, I don't get to collect Social Security for another 4 years. So I know that right now I want to be conservative. I want to make sure that my funds last me. And sequence of return risk is really high at the beginning of retirement. But now like something like QQQI being 7.5% above my cost basis, I'm not as scared as I was when I first retired because I can handle a good 10% drawdown and it's just be below my cost basis. So I sit back and I'm not as worried now as I was when I first retired.
What do you think investors get wrong about income and cover call ETF investing?
That you're going to be able to beat the market. Some of these funds can, some of these funds don't. Can they do it a long term? We don't know. I mean, KQQQ is literally beating the Qs. Can they do that long term? Maybe. QDevo appears to be able to beat the Qs on total returns. Can they do that long term? Maybe. There's just not enough data out there to tell us that, hey, these funds are going to beat it long term. So stepping back, having that growth side in the Qs and only having what you need on income is probably the best of both worlds.
How do you handle criticism of investors who might say that dividends are a trap or that cover call ETFs underperform the market and you should avoid them at all costs?
Those are the people that aren't living on the distributions. Rebuttal is, what's your plan? And a lot of these financial advisors have a plan. And is that plan good for you? Take a look at it. Maybe these financial advisors saying that might be correct. But maybe these financial advisors will also tell you, oh yeah, we need you to put 5 years in cash and put it in the bonds and do a bond ladder just in case the market takes a downturn. And then we can sell them later when the market recovers. Well, that's not the type of investor that I am. I don't want 5 years in cash. But maybe that's what you would like. And creating a plan that's right for you and right for maybe a financial advisor, that's all an individual decision.
What are some key habits that helped you invest to get to this point of $1 million plus portfolio and much more, and that allowed you to build wealth and consistency when investing?
Following the trends. That's the best thing I can tell you. I should have followed the trend of Bitcoin back in 2000. I bought a little bit. I was involved in crypto in 2017. I recognized that Microsoft, when it was at $28, was going to be something that maybe I should have bought because I knew that was in every single office and every single office worker was going to be using it. That's a trend. I see that AI is a trend. Now, when that trend changes, you might not want to be invested in it and you might want to divest yourself, but follow the trends. I mean, it's clearly AI is the trend going on in the marketplace right now.
How do you invest in ETFs? Do you lump sum or do you dollar cost average, and why?
As a younger person, I was DCAing. You know, you invested in your IRA and it just went in. As a retiree now, I wait for the pullbacks before I try to put money in, or I try to buy something at what I feel comfortable with. I think I came up with different rules of, hey, I wasn't going to buy a Bitcoin ETF unless Bitcoin was below this price, Or I wasn't going to buy this Ether ETF until Ether was, at some reasonable price, and it wasn't at $4,000.
For somebody starting today with $10,000 to invest in the market, of course, this is not financial advice. Do your own research. Investing is risky, but how would you suggest that they invest to build towards your level of income from dividends?
It depends if they need income or not. That is probably the best answer. If they need a little bit of income, maybe you invest in something in the Qs. Take your pick. QQQI, KQQQ, QDevo. Take your pick if you need some income. If you're really younger and you're just starting out, maybe you pick up one of the single stocks because you have time on your side to recover, where somebody older needs to start thinking a little more conservatively.
If you could buy only one ETF forever, which would it be and why? And one stock forever, which would it be and why?
My answer doesn't change. QQQI is my fund that I hold forever. My single stock as of today is NVIDIA.
Thank you so much, Brad. The Income Architect on YouTube. You guys could check out his channel on your screen. Go ahead and subscribe. It will be in the link in the description of this video and in the pinned comment section. Now, if you guys like this video, please give it a like because of this Q probably did. Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.